Accidental self-trading is actually something that's pretty common. It can happen under a number of circumstances. That's not necessarily the same as illegal wash trading, where there's real intent to actually manipulate the market by driving up volume. By doing so, I mean, you're actually putting out information to the market participants, causing them to potentially jump in and trade. At the end of that, the result could be some price distortion. So it is a different thing, though the concern is very real. And because it's difficult to prove intent, we find that a lot of customers of ours certainly are just interested in preventing all types of accidental self-trade. So that's where software can step in and provide a bit of a solution there. So recently there was a report on the flash crash in the treasury markets on October the 15th of 2014. And when we say crash, we're really talking about a window of about 12 minutes in which there was activity. So I think what was most interesting to us as a software company was that during that 12-minute window, self-trading actually accounted for about 12 to 15% of all the transactions, which was, I'd say, eye-opening, especially as self-trading has been under a lot of scrutiny lately. Certainly a lot of our customers have demanded that we offer a solution to help them prevent accidental self-trades. TT has actually had a feature called Avoid Orders That Cross. We've had it in the platform for a while now. Some exchanges have their own opt-in versions of self-match prevention. These essentially work in one of two ways. When an order comes in and it can potentially match with another resting order, one of two things happen. Either you reject the new order or you cancel the resting order. Both of these are relatively heavy measures to take, in that a lot of this tends to be accidental. So you have users really without full visibility into what's going on everywhere inside their firm. They have strategies that are working. They have resting orders that are suddenly just pulled from the market, and they're left scratching their heads a bit. So we did think that there was a better way of potentially addressing this. We released recently on the new TT platform a self-match prevention feature, which we call position transfer. The idea there being that rather than absolutely rejecting the new order or pulling the resting order from the exchange, we'll actually intercept the incoming order when there's a potential match, and we'll go ahead and we'll just then cancel or reduce the working quantity at the exchange, and then we'll just generate two fills internally for both traders. In terms of the position transfer functionality itself, we've gotten several small requests for enhancements. For example, orders might not quite match on price, but it still might be in the best interest of the firm to have those match if they're just a tick or two off. So making things like that configurable, it's something we plan to offer. Other pieces of this is just the complexity of, well, how do you price the spread legs of two matching spreads when they don't actually get filled at the exchange? So the algorithms for that type of stuff are things that we're working on and we're putting out